Lance Roberts here with 3 minutes on markets and money for this Monday's edition, and talking a little bit about the last week of July as we wrap up the last week of July, getting ready to head into August and September. Well, what does the market hold? A couple of things we want to take a look at in particular here is that consumer confidence has turned back lower here over the course of the last month, because as we saw that initial recovery in the economy, people going back to work, we went from 0 employees in restaurants back to some employees. We did see a little bit of a pickup here, a little bit of confidence pickup here, not surprising, but as people really come to the grips of reality that there's 50 million people unemployed, that temporary layoffs are now becoming permanent. We're seeing a rise in virus cases, potentially is going to lead to shutdowns in states again, or at least a reversion of the reopening process. That's beginning to weigh on confidence, and that's an important thing, as consumer confidence really relates to economic recoveries to a great degree. Also, as we enter into August and September, July 31st, as we move into August in particular, is the start of the weakest 60 days of the year from a seasonal basis, and especially for the markets. So while we've had a very good July, we talked about that in this past weekend's newsletter. It's on the website now. Simply go to the website, realinvestmentadvice.com, click on the newsletter link. But we talked about that July has played out relative to its July kind of seasonal statistics of being one of the more positive months of the year. It's performed very well. But now we're moving into August, September. This is where we run into the debt ceiling. We've got a lot of stuff going on in terms of economic data potentially getting weaker here. We've got a rise in the virus cases at a time in August and September is where flu season starts. Now we'll have the kind of the combination of COVID and the flu. People won't know what they've got. That could potentially lead to even slower economic activity over the next couple of months. And then we head into the election. So lots of stuff that could potentially weigh on the markets here as we move forward. The relationship historically between consumer confidence and the market is very high. So given that consumer confidence is still very, very low here, the fact that the yearly return of the market has been so strong this year is likely to pay a bit of catch up here over the next couple of months. So, a bit of a correction in the markets, particularly if we don't get additional stimulus or additional support or enough of it from the government, we could see a contraction in equity prices to some degree. And that really kind of leads us to where we are with the markets today. Now, markets, again, had a very strong July rally as we expected. The 50 days crossed above the 200-day. Our money flow buy signal still in place, suggesting that stocks remain strong at this point. But again, the money flow buy signal and our buy signals in general, very extended. The market is overbought short term. So very likely over the course of the next couple of months, we could see prices continue to struggle here a bit, particularly as we deal with some of these other macroeconomic factors, as well as earnings factors over the next couple of months as earnings begin to contract here, particularly as we get more forward guidance into the year. That's 3 minutes on markets and money. I'm your host, Lance Roberts. We'll see you next time.